Welcome to Nasdaq Trade Talks. I'm your host, Jill Malandrino, global markets reporter at Nasdaq. Joining me at the market site in Times Square, we have Dave Weisberger. He's the CEO of CoinRoutes. We're going to tackle our favorite discussion, making markets more fair. Dave, it's great to have you back with me at the market site. And what we like to do is talk about the good, the bad, and the reality. And the good part of this is speed bumps. They do make sense at some point.
Yeah, so when you asked me to talk about my favorite topic, IEX, and I put that in quotes because frankly I care more about digital asset markets now. But the reality is I have been pretty outspoken on the IEX topic for many, many years. And one thing I want to be very, very clear, because there are people who don't realize this, but there's a lot of good that came out of IEX jumping onto the scene. Unfortunately, there's a lot of not so good. The good is that the better dark pool design that they ushered in, which hasn't been universally updated, but clearly makes sense, which is a speed bump in the case of orders that are derived from other prices. So if you are making a market, you're providing liquidity, and you're doing so in a marketplace where the price that you're providing it there depends upon what's happening in other geographies, it clearly makes sense to have some mechanism to ensure that you're not pricing at a stale price. So dark pools could use a speed bump. Admittedly, it could be much slower than IEX's speed bump, or much shorter, excuse me, and et cetera, but it's logical. And as a result, they gained market share very quickly and became a very important dark pool. Unfortunately, as an exchange, 3 years later, as the Financial Times article talks about, there's still a dark pool.
Right.
And that's also not all that surprising.
So do you think now, if we talk about the bad part, if you will, that there's a mischaracterization of markets?
Well, look, I've written so much about this. I don't want to rehash old arguments, but the notion that rebates are evil or kickbacks is nonsense. The facts are facts. Agents in the marketplace that don't pass on their fees or rebates do have a conflict of interest. That's true. And that's why the buy side and other people want this transaction fee pilot to go on. The other fact, liquidity providers who are committing their capital in order to improve markets and make a profit while doing it are vitally important for the market, and they have no conflict of interest with rebates. Now, when you characterize that set as evil, you create bad feelings. You create all sorts of rhetoric, and that rhetoric that goes on and ends up in politics causes all sorts of issues. So that's why you have an overbroad pilot, which is trying to get at a serious issue, which is conflicts, with a very broad brush. And that's why you have the issues that are going on today with lawsuits, et cetera, going back and forth.
So then what's the reality of market structure as we are right now?
Look, the reality is it's very hard to be perfect because there's multiple constituencies, but the market generally functions pretty well. There are changes that are going in or have been approved for better disclosures, which will help. But at the end of the day, there are still always need for improvement in disclosures so that these conflicts of interest could be understood. It is potentially also true, in fact, guaranteed to be true, that the artificial price level that was set back when Reg NMS went in 2007 is probably wrong. Right? I mean, why is 30 mils or 30 cents per hundred the ironclad price that has to be for rebates? I mean, obviously it should be related to spread. It should obviously be related to the price of the stock. There are obvious other things that one could do to do it better. So it's not like we're perfect. The real question is, and it comes down to that FT article, why did IEX flatline at 3% market share? It's well because they don't incentivize market makers, which means their lit liquidity is not good. And when your display liquidity, which is the primary reason for being an exchange, isn't good, you're going to reach a plateau, and that's more or less what's happened. And unfortunately, while they have a lot of brilliant people over there who are doing a lot of really cool things, that rhetoric where this refusal to back down on this notion that paying for order flow is somehow, a kickback or evil another way is holding them back from what they could actually become. So that's really the sad.
And because it seems intuitive that you're going to incentivize the market makers. Why would they take on the risk otherwise?
Well, it is intuitive. It is true that you can incentivize market makers in a lot of ways. You can do it like futures do and have artificially even wider tick sizes. You want to make the tick size a nickel again? Sure. You could incentivize market making in those thick stocks. You'll get more. We did a tick pilot, but our tick pilot was really narrow, only a nickel, and only in a very small segment of stocks. There probably was an improvement, but it was such a small segment of stocks for such a large pilot that it cost people a lot of money. The reality is it's a lot easier to incentivize market makers on a scale based on what's going on, and so rebates have sort of evolved. I mean, this market didn't just happen It evolved for a reason.
Right.
You ended up with inverted exchanges for ones where the tick size was too wide. You ended up with the higher rebate exchanges for the ones where it wasn't. And we also have a almost nonstop cacophony that I happen to agree with, that says the market is good for large cap, but not so good for smaller cap stocks, who generally have wider, bid-offer spreads, where the liquidity rebate is not sufficient to incentivize market making.
So just to go back to the question I always ask you, is it a one-size-fits-all model? Because it doesn't sound like it is.
Well, we have one, and and the market has adapted to try to make it a little bit less one size fits all.
But it's not.
But the rules are one size fits all.
Yeah.
I mean, look, I think I told you this story before. In 2008, I played Don Quixote. I was at Lava Flow, which was a displayed ATS. Doesn't exist anymore. There aren't any ATSs that do that. But I tried to go to basis point pricing. And I got told from virtually everybody, oh, no, we can't do that. It's too complicated. Now, my brain hurts because, obviously, basis point pricing, which the rest of the world does, with the exception of Australia, Canada, and the US, it's all basis point pricing, but somehow that was too hard. But it failed because people didn't want to adjust the way they're thinking. That kind of market that wouldn't be one size fits all clearly is where the future needs to be. My fear is we're not going to get there anytime soon because of all the political hand-wringing and everything that goes on with market structure.
Right, and I can understand why you were definitely moving into that digital asset space, which we will
Correct.
get to. Thank you so much, Dave, as always.
Take care.
And thank you for joining me on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.